Welcome back to Market on Close. Let's look at the role of options throughout this sell-off we're getting in mid-December, but also the role of big positioning and flows that have informed our coverage throughout the year. Kevin Green been on the options corner beat with us. KG, as we are looking back kind of at our discussion here the last 6 months in the year, how much do you think options flows have played a role in kind of dictating moves in this market?
I think it plays actually a pretty decent role here. It's not the end-all be-all. Obviously, news flow is going to really command the marketplace, and you also have passive flows. But I think when you're looking at it on an intraday basis, the options positioning has definitely dampened volatility, Oliver. And even when we do have volatility spikes like we've seen over the last couple of months, the reversals in those vol spikes have been fairly quick as well. And I think that's because you are able to spread out risk across multiple expirations, giving the market a little bit more, direction or a little bit more comfort in order to be able to hedge positions to the downside. Now, when we do have very outsized days, it could also create a little bit more of a push to the downside or even to the upside if we're seeing a squeeze. But I think overall, a lot of the 0DTE options flow, which is around 60 to 65% of the total S&P 500 flow on average on a daily basis, has actually been a pretty good thing for the market rather than a bad thing for the market, because it's been able to dampen once again vol, and then also kind of creating this like melt up over time type of environment for the markets. And let's see if that's going to actually hold true into 2025 as well.
One of the things that I definitely got some more awareness, familiarity, knowledge of this year is the stuff that you track on the market maker positioning and where those kind of pressure points are. I found it enormously useful, especially when we are trying to kind of assess when a move is unique in the market, because to me, the fun stuff happens in markets when there's surprise involved, basically. A company, has a big earnings beat or a miss, or Powell does something people didn't think he was going to do. It's basically surprise. So what we're monitoring a lot is when there's a degree of surprise on behalf of like the biggest participants that then have to make adjustments.
Yeah, and that's usually after a one standard deviation move. So usually when you're looking at options premium itself, those market makers that are actually making the pricing or trying to make the pricing for options, they're going to try to give themselves enough premium in order to try to weather the storm if they do see an event to the upside or downside. But you could see these massive squeezes in the market where there's just so much outsized buying of call positioning and to the upside, whereas the stock continues to move to the upside and more calls are being bought. Those dealers have to kind of continue to buy stock, and that's where you get these melt up scenarios. A really good example of that has been Tesla as of recent, where we did see Tesla just rocketed higher. Now, did they have the news flow? Yes, obviously post-election, but you started seeing a lot more optimism, and a lot of individuals and investors were actually looking towards options rather than buying stock in order to get exposure, because you have a little bit less of an outlay when it comes to the premiums. And so that type of excessive call buying really moved the stock up to all-time highs in a matter of 2 weeks, 3 weeks, Oliver, which is something that's very remarkable. Let's see if stuff like that's going to really hold on for the new year in 2025. That's just one example of among many that we have seen. The other example that we actually have here on this chart is just the volatility of the VIX index. Now, this is a seasonality chart, and this is really showing, in that red line is showing you the average of what the VIX was on a 10-year basis, and then the blue line is showing you what we did for this year. Now, you see in the middle of that chart, we had this massive spike to the upside, and that's when we had this kind of yen carry trade type of scare in the market. The unwinding of those carry trades. Would we see the Bank of Japan making excessive actions when it comes to the foreign exchange markets? And we saw this blowout in volatility in the S&P 500 options. But the reason why we saw volatility spike so high is because now S&P 500 options are traded 24 hours a day, and we saw a lot of illiquidity overnight, which is one of the reasons why we saw that huge spike in vol, and also the huge drop in volatility the next day when we started seeing liquidity coming back into the market. So options continue to evolve. These markets are continuing to evolve here. We just have to get used to these new dynamics that could actually put a little bit of pressure in the market, but also could give us a little bit of favor if you're a bull over the long term.
Yeah, I like that. Very well said. And we did see a lot of that real juicy price action happen in the heavy options trade. So it really is no mistaking in my mind where some of the extra grease on the wheels can come from. And it certainly is from some of that back and forth within the options market. The other thing, too, I love about this chart is it tells us some of our big volatility spikes this year were at like the most inopportune moments at which people are usually expecting low vol, whether it was August and the midsummer or in the Santa Claus seasonal rally time.
Yeah, exactly. And actually, when you're looking at the Santa Claus rally time here, we could see vol maybe reverse. And that is something that we will have to see here, because it's going to be an environment. We will have an environment usually towards the latter half of the year where liquidity actually does dry up. Volume dries up a little bit. And that actually gives a little bit more favor to price action, either to the upside or downside. But the market generally is bullish over time. We can see that on a 10-year chart, 20-year chart, max chart. You can see that the market generally tries to melt up over time. And even though we had a recent vol spike, if you kind of look back at that chart, they usually don't last for that long, maybe 2 sessions, 3 sessions. Then we have a normalization and we continue to move forward. The market is able to digest some of the unknowns or some of these kind of recent volatility spikes a lot quicker than what we have seen in the past. And that once again gives credence to the fact that this market has been able to continue to push higher. And I think this is one of those dynamics that's rarely talked about, but something that has provided a little bit of fuel to the fire for the bulls in this market as of late, because a lot of the bears just can't short this, no matter what news has been given to us throughout the year, with its yen carry trade scenario, Trump and potential assassination attempts. I mean, we've seen it all this year, and the market has been able to digest it fairly quickly.
Yeah, really have been pretty fun stuff. And the irony that the one thing that wasn't a problem basically all year, bonds, which were the biggest problem a couple years ago, kind of came back to haunt us a little bit. The Grinch, the bond market Grinch. So at least we got kind of one vol spike here that was a little bit more kind of familiar, but I don't know, it might be the kind of worst one because we got bonds and stocks selling off again. So the bond vol is about to pick up as well, which had been pretty quiet all year. We kind of awakened the sleeping beast. Give me a last thought on that.
You know, that's actually very interesting. If you're looking at bond vol just in general, is it elevated? Yes, but compared to the actual realized move, compared to what's being implied in the market, you're not really seeing a lot of juiced up premiums when you're looking at the bond futures. And that's really what I judge a lot of bond volatility on. That actually has been, for the most part, subdued, even though we have seen the increase in rate volatility on a day-by-day basis. And that's something that may need to normalize in 2025, Oliver. I know that you're the bond guy, and I have never seen bond volatility like this, or when you're looking at the actual realized moves in the interest rate complex, I haven't seen moves like this sustain itself for as long as we did this year. And hopefully that actually moves to the downside or kind of subsides next year. And that's going to make it a lot easier when it comes to trading equities, as well as when it comes to the premiums for options, because even though it's a very small part,
it's in the
bond volatility and rate volatility is actually in the math of the Black-Scholes model.
For sure. Good stuff. Good connection there into the options pricing. And as we have this discussion, this is on a day in which we basically had a failed 5-year auction where dealers took down a ton of bonds. So equity traders are hoping it cools off. We'll see what happens. Thanks, KG. Great stuff on the options corner all year. Great eyes on the technicals and how they overlay with the options flows.